Hi, everyone. Jim Kruzan here. Hey, we just finished the month of July, and I thought I would just send out a quick message to let everybody know what's been going on with respect to the market, and is the market changing at all from the trend that we've seen over the last year plus? As I've said a number of times now, in our opinion, there are three things that can happen. The data, which still looks somewhat recessionary, continues to weaken until we see a sizable drop. The drop will generally, as is typically the case, come out of the blue, and in short order, we have a sizable drop to the market. That's typically how recessions work. It's not like landing a plane on a runway, nice and easy. Everything is fine. Market's going in an upward direction. Economic data is going in a downward direction. And then all of a sudden, it's sort of like the bottom drops out. So we're watching for that. We're protecting for that. A second thing that could happen is this soft landing. Now, the market, that's their base case. They're assuming that everything is just hunky dory. Now, we've mentioned before that soft landings are difficult to achieve. The government's had one in the last 75 years, and they're hoping to pull off another. If that's the case, then a lot of the same economic data should start to reverse and improve, in which case we feel more encouraged that a soft landing is, in fact, in the cards. In either case, the third thing could happen, which is a broadening out. For the longest time, I've been suggesting that a lot of the market return, the S&P's performance, has been really attributable to the Magnificent Seven, these big tech stocks that are up significantly, in part because of the euphoria over AI. When you weed out those seven and look at the other 493 stocks in the S&P, you really see a very mixed message. So the market itself, while it's certainly high and performing, is certainly not indicative of the economy, but hype, much like the same hype we saw back in the late 1990s during the dot-com bubble burst. But should the economy, or I should say the market, broaden out, that might very well be encouraging. Maybe the market is telegraphing better times ahead. The one thing we have to be concerned with is whether this broadening out is just a last stage effort for return. That typically happens as well, kind of the last gasp of the market. So we want to watch and follow this very closely. As far as other macroeconomic data, since the last time we spoke, it's all much the same. The leading economic index dropped again for the month. It's now dropped 23 of the last 24 months and has been in a negative trend for well over the last 2 years. The drop now that you'll see in the far right-hand corner of the graph is actually now the second largest drop ever recorded. This has been a predictive indicator. It has coincided always with every major recession we've had, all 9 recessions in the last 65 years. So to think that this would be different this time might be, but that's a big assumption. So this is clearly still a yellow, if not a red flag. Yield curve still inverted, although it's beginning to flatten out. More on that in a second. The blue line represents where we are now this August. The line just above it was the yield curve from a year ago, a little bit more inverted than we are today. And then the line at the very bottom was 2 years ago, where it was more or less a normal, healthy curve where short-term rates were lower than long-term. Anytime we have an inversion, it's indicative of some credit issues. It also tends to make banks retrench and become unwilling to lend as much. So economic activity tends to fall. This is also a major indicator of potential recessions ahead. To give you an idea of the predictive nature, I've shown you this slide before. It goes all the way back to the 1960s. You'll see the gray vertical bars, which represent recessions. Anytime you see a blue squiggly line above the red horizon, that's a positive yield curve where long-term rates are higher than short-term, healthy, and normal. On occasion, the blue line is below red, where the yield curve is now inverted and short-term rates are higher than long-term, much like the position we're in today. A couple things about the chart. First, if you look at where we are today, this is now the longest inversion ever recorded. Now, I know if you look at the chart, it'll look like it was much longer back in 1980. But if you look very closely, you'll notice those were two separate recessions, back-to-back recessions. We had an inverted yield curve, then we had the recession in early 1980. It normalized, it then inverted again, and then we had a recession in 1982. By the way, that was the only recessions we've had to deal with where we had a high degree of inflation, which made it more difficult and more challenging for the Federal Reserve to deal with the recession. So the combination of that recession, both of those together, was a sizable drop in the market, as is any typical recession. And you'll notice that in every single case, with no exception, and I realize it's a small sample size, we've had an inversion and it followed up with a recession. It isn't the inversion that's the triggering point, but rather when things start to normalize, that's when the recession occurs. We're beginning to see the yield curve starting to normalize. It's starting to flatten. The question now becomes, how is it flattening? Is it flattening because short-term rates are coming down? Or is it flattening because the market is pricing higher yields on the long term? And they're doing that for two reasons, potentially. One, they feel that maybe inflation's a bit stickier and will be around a bit longer, so they need a higher yield to compensate for their money lent. Or two, they're a bit concerned with the $36 trillion of debt and the issues that that all creates. The fact that debt service becomes such a huge amount of our national budget that requires to cover the investment by requiring a higher rate of return. More on that later. Over time, we'll see what happens. But the yield curve still inverted, longest in history, starting to normalize, as is typically the case, before going into some type of a recession. Again, it's not a guarantee, but this is certainly what the data is suggesting. I mentioned this before. This is the SOM rule. There's been a lot of news on it lately. I've been talking about this for about a year. The SOM rule measures, or it's a predictive tool, which uses the unemployment rate. The unemployment rate by itself is not predictive. In fact, it's a lagging indicator, doesn't do much good trying to predict with it. However, the rate of change, how quickly the unemployment rate rises from any base is. And Claudia Sahm, who discovered this, connection, suggested that if you look at the last 3 monthly inflation rates, average those out, and you look at the lowest unemployment rate that we've seen in the last 12 months, if that spread gets over 0.5%, we're right on the cusp of a recession. So this blue line represents that spread between the current 3 months and the lowest rate in the last 12 months. Notice during 2020, COVID locked everything up. Inflation went from like 2 to 14%. The spread just soared. But generally, the spread is hugging right around 0. And you'll see once it gets up to about 0.5%, right on the front edge of a recession every single time. We are now just over that 0.5%. The 3-month average is, I think, 4.16, and the 12-month low is 3.6, 5.16, just over that. So these are big macro issues. which are highly predictive. One can discount it by saying, well, it's going to be different this time. Well, to suggest it's different this time in all three cases, another reason to be a bit cautious here. In addition to all that, we also see what would be considered high frequency data, things that change really quite quickly, that are beginning to somewhat bubble up from the surface. The way economic data flows, big week of data followed by kind of a light week. This week, the first full week in August, is a light week. Last week was a heavy week. And last week, the release of some of that data looked like this. The LAI, which reported out, continued to drop further. Credit card delinquencies are now nearly 11%. That's 11% of all credit cards out there and open. A year ago, it was just over 8%. So that's in 1 year, a 30% increase in delinquencies. And that's happening when we're not yet in a recession. Manufacturing has been in a recession for quite some time. The manufacturing index fell again, and that's 4 consecutive drops in a row. New factory orders also dropped, a general slowdown. In terms of initial jobless claims, unemployment claims, they were much higher than expected. In terms of employment surveys, number of people hired, full and part-time, there's actually been more part-time than full, much less than expected. So we're not seeing massive layoffs. We're just not seeing a lot of new hiring. First step along the way. Chicago Business Barometer fell again, unemployment rate increased. And in addition to that, the U.S. employment report, which is different, also showed fewer new jobs created than expected. One thing I found interesting was buy now, pay later. I mentioned it before to many of you that during Christmas retail sales, about 30% of all transactions were buy now, pay later. And to me, that would suggest some real economic hardship. Consumers are kind of tight. They don't have money to write a check or use a debit card because there's no money in the checking. All that extra government money has now since been spent. They can't put it on a credit card and just make small payments over a forever period because they don't have room. So they're forced to use these buy now, pay later programs and apps where you purchase something, take it home, and you then pay the finance company over 4 months, 4 equal payments. The interest rate is ridiculously high. Well, the delinquency rate on that type of activity is now about 43%. And then we talked about the SOM rule being violated here as well. So all the while, all that was going on, and I mentioned this the last time we spoke, during the first half of the year, it was a very concentrated market. S&P was up 4, NASDAQ was up 7 for the second quarter, S&P was up over 15, NASDAQ was up 19. But the Dow was actually down for the quarter and barely up at all for the first half. The Russell was down almost 4% for the quarter and barely up at all for the first half. And bonds were also down significantly for the quarter and the half. And the reason, as we surmised, was it really had a lot to do with the Magnificent Seven kind of pulling things up. These are the individual stocks: Microsoft, Apple, Google, Amazon, NVIDIA, Meta, the old Facebook, and Tesla. And those are the returns for the quarter and the first half. And then what I did is I actually just multiply those individually by their unique individual percent allocation of the S&P. As an example, Microsoft is a little over 7% of the S&P 500. Apple, well over 6. Amazon, about 6. NVIDIA, well over 6. So you multiply those returns by 7% or by 6% and average those up. And for the second quarter alone, those 7 produced 5.98% contribution to the S&P. The S&P was only up 5.1, meaning what does that say for the other 493 stocks? Well, you sort of get an idea here where the Dow Jones was actually down, the Russell was down, while the S&P and the NASDAQ were up. So not particularly a very healthy market. And for the first half, same story. Those 7 represented 15.3% of the overall contribution to the S&P, and the S&P was up 15.13, again, over 100%. So that was then. That was through June. We just finished July. What's happening now? Well, for the month of July, and July by itself isn't a trend being made, but we began to see a bit of a broadening out. The Dow Jones was up 4% in the month versus the S&P up 1%. The NASDAQ was actually down. And the Russell, which had been down significantly through the first half of the year, was actually up 10% in the month of July alone. And bonds were also up. So again, we're looking at this broadening out. Maybe it is a healthy sign. Maybe it's a sign that the economy is improving. Maybe it's a sign that better days are ahead. Or it might be a last-ditch effort, which is typically what you see as well when you have these very narrow markets and a lot of economic activity that looks somewhat questionable. Remember, we're looking at this. We'll talk again next month, and we'll see what August holds in store. So far, just as a teaser, the first 4 or so trading days has been quite volatile. Big drops followed by some recovery as well. So we'll just see what that all means. But we're watching it, so you don't have to. Have a wonderful summer. Well, we'll talk to you at the end of the month. And as always, if you have any questions at all about any of this stuff, please give us a call. That's what we're here for. Myself, my entire team. We're 17 individuals strong now. So with that in mind, see you again soon. Take care.